Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're navigating some pretty choppy waters. You kind of feel it in the air, don't you? These whispers of recession, a lot of talk around like an AI bubble maybe, and just that constant hum about interest rates is the kind of environment that, often sends investors running for cover, maybe towards cash. But our mission today, it's to explore a really fascinating, almost defiant, contrarian view. We're diving deep into an article called "I'm Buying This Market Dip with Leverage" by Tony Hicks. We're going to peel back the layers on his arguments for buying dips with leverage, try to separate his approach from just reckless gambling, and really get the strategic thinking behind it, all based just on what's in this piece. So let's get into it.
Yeah, and that's a really crucial distinction right up front, isn't it? I mean, buying the dip, everyone knows that phrase. It's almost a cliche when markets turn down. But the second you add with leverage, that definitely raises the stakes. It triggers this kind of gut reaction for most people, usually negative. This article really seems to want to demystify that whole aggressive angle, frame it less like a Vegas trip and more like, well, a calculated strategy if you've got the right mindset and, importantly, the right controls in place.
He certainly grabs your attention right away, doesn't he? Kicking off with that analogy, investing without risk is like ordering a margarita without tequila. It's just sad juice.
Yeah.
Wow, what's the sort of core philosophy he's trying to hit us with right from the start, using something that provocative?
Well, it's fascinating how he just immediately stakes out his ground on risk. He's not pretending leverage isn't dangerous. He absolutely says, it can blow you up. But then he draws these parallels to, like, everyday risks, driving a car, eating shellfish, making big life choices.
Things we all do.
Exactly. Things we all do that carry risk.
Right.
But we manage them, right?
Yeah.
With preparation, with understanding the dangers. For him, leverage, used strategically, it kind of falls into that bucket. It's a tool. Dangerous if you misuse it, sure,
Right.
but maybe essential and manageable for getting those bigger returns. It's about seeing risk as just part of the deal for reward, not something you avoid entirely.
That's a really interesting perspective shift. And speaking of perspective, he absolutely nails that feeling, that emotional roller coaster during a market correction. He lays out this whole familiar script, headlines screaming doom, social media folks crying about their portfolios, YouTubers yelling, sell everything now. I mean, I know I felt that pull before. It's so visceral. What makes us so prone to that panic, and how does he see it?
Oh, it's classic human psychology, isn't it?
Sure.
Herd behavior, loss aversion, we hate losing more than we like winning, and just thinking really short term. When everything feels uncertain and negative, that instinct is just protect what you have left.
Right.
But that raises the question, if everyone's panic selling, who's buying? And the author's view is pretty blunt. People like me are on the other side of those trades. It's pure Warren Buffett, right? Be greedy when others are fearful.
Okay.
For this author, buying the dip isn't brave. It's just logical because others are being emotional. But adding leverage to that, that's what elevates you, in his words, from just being a contrarian to being a full-blown market pirate.
A market pirate. Okay.
Someone who's not just buying, but like aggressively capitalizing on that fear.
So he draws this really important line, I think, between real leverage and what he just calls pure gambling.
Yeah.
For listeners, where's that practical difference? What makes his approach different from, say, maxing out credit cards to buy Dogecoin?
Yeah, that's absolutely central to his whole argument. He's quick to say real leverage is not that. It's not using your credit card for speculative stuff or, jumping on some TikTok trend for weekly options. That's just reckless, he says. What he means by real leverage is using specific, sometimes pretty sophisticated tools. Things like margin accounts, certain leveraged ETFs, maybe futures contracts, and this is the key, using them strategically. With a plan, with a defined risk framework. He gives examples, like maybe using a 2x leveraged ETF, but only during a specific accumulation phase, or taking advantage of really low margin interest rates if they're available, or even selling covered calls against those leveraged positions to bring in some income, lower your cost basis.
Interesting.
The core idea isn't just bet big. It's more like control more asset with less capital, but do it smart, and critically survive to do it again. It's about amplification, not desperation.
It is really interesting how every single market dip, when you're in it, feels totally unique and unprecedented. He points this out so well, like 2008, it felt like the whole financial system was genuinely going to collapse. Then 2020, the virus was going to end capitalism as we knew it. 2022, inflation was the apocalypse. Every time, it feels like this is the big one, until, later it looks like just another dip on the chart. What's his takeaway from that pattern? Why does he think this dip isn't different?
His conclusion is pretty straightforward. Today's fears, whether it's tariffs, debt stuff, AI valuations, some geopolitical boogeyman, they're just the latest version of temporary overreactions. They fit the historical patterns.
So just noise.
Well, significant noise in the moment, but temporary in the grand scheme, according to him. He argues markets are like these forward-looking machines. They price in fear super fast, often before the worst news is even fully out there, which implies that by the time everyone is screaming sell and the headlines are all gloom, well, the smart money, or at least his money, is already buying. When he sees that widespread panic, he sees opportunity, not just for a small position, but potentially for, as he puts it, loading up the cannons, using leverage, because the market's likely already factored in those known fears. It's a belief that, well, human emotions are more predictable than the economy sometimes.
Okay, so if it's a recurring psychological pattern, what are the specific things now that make him so confident? Why this current dip for this strategy? What's underpinning his conviction right now to double down with leverage?
He actually lays out 5 specific points for why now. First, he mentions valuations. He thinks some high-quality stocks, Apple and Microsoft, those reliable dividend payers, are trading at prices that don't make me want to throw up, as he puts it.
Okay. So attractive levels.
Attractive entry points, yeah. And leverage can compound returns from there. Second, he anticipates rate cuts. Maybe not tomorrow, but eventually. He sees those as potential rocket fuel for leverage positions because borrowing it's cheaper.
Makes sense.
Third, earnings strength. He's looking at corporate profits and saying, hey, they're not falling off a cliff. Companies are still making money, which supports stock prices, especially leveraged ones.
So fundamentals are okay.
Fundamentally sound, in his view. Fourth, sentiment. He says it's trash, which to him is perfect. You know, surveys show high fear, social media is bearish. That means there's a lot of potential buyers on the sidelines, fuel for upside when things turn.
Classic contrarian signal.
Absolutely. And then the fifth reason is pretty direct, because I can, which speaks to his personal situation. He feels he's done the homework, he's set up his risk controls, and he has the stomach for it. It's about market opportunity meeting personal readiness.
That because I can really drives home that this isn't just about the market, it's about the individual investor. It sounds like incredibly high stakes, though. So how does he claim to avoid, blowing up? Especially when he himself points out that lots of traders treat leverage like a Vegas weekend. What are his non-negotiables?
Right, and this is where the calculated part really needs to shine. He outlines this 5-part approach to what he calls precision leveraging. First is diversified core leveraged edges. Basically his main solid investments, they're unleveraged, they're the ballast. The leverage is applied only at the edges on specific high conviction sectors. He mentions AI infrastructure, energy, some dividend growers.
Okay, so not leveraging the whole farm.
Definitely not. Second, define risk parameters. He stresses knowing exactly what his downside is before he even buys. And a commitment to cut losses fast. No diamond hands philosophy here on leveraged plays.
Discipline is key.
Absolutely essential. Third, something he calls income offsetting. Selling options like covered calls against the leveraged positions. This brings in cash, lowers his cost basis over time. It's a way to kind of buffer the risk.
That's a bit more sophisticated.
It is. Fourth, tight monitoring. He's very clear. Leverage is buy and babysit, not buy and forget. You have to watch these positions constantly. It's active management.
Right, not passive at all.
Not even close. And fifth, maybe the most critical rule, no margin calls ever. He insists on sizing positions so carefully that he never gets that dreaded call from the broker. Living one margin call away from disaster, he says, that's pure gambling, not his strategy.
That really draws a line, doesn't it? Avoiding that margin call at all costs.
It crystallizes the difference between strategic risk and just being reckless. Preservation of capital, even when using leverage, is paramount.
Okay. But even with all that planning and those rules, you just know there are critics who would still look at this and say, that's just crazy. He seems to anticipate that. How does he respond to the skeptics?
Yeah, he doesn't shy away from that criticism. His retort is pretty sharp, actually. He basically argues that the people calling it crazy are often the same ones, parking their cash in 2% savings accounts while inflation eats them alive.
Ouch.
Yeah. Missing out on potential compounding gains over decades. He fully acknowledges leverage magnifies losses, but it also magnifies gains. For him, the difference between success and failure isn't the tool itself, it's whether you actually understand how to manage it. He believes most people don't, but that he does. It's kind of a dismissal of critics who prioritize safety above all else, potentially missing big opportunities.
So when you boil it all down, what's the ultimate objective here? What's the end game for this investor pursuing such an aggressive leverage dip buying strategy? It can't just be about bragging rights.
No, he frames it very clearly as being about accelerating wealth when the odds are skewed. He genuinely sees these market dips as rare gifts, moments where you can, and this is his phrasing, pick up dollars for 50 cents. And then with leverage, he says, that transforms into picking up $5 bills for the same 50 cents. It's pure amplification of opportunity. He's upfront that it won't be smooth sailing. There will be volatility, there will be drawdowns. But his core belief is that the market, over time, rewards patience, courage, and strategy, while punishing panic. The end game is maximizing the potential uplift that comes from others' fear, banking on history favoring decisive action in downturns.
Well, it's definitely clear that this kind of aggressive play isn't for everybody. It demands, like you said, huge discipline, rigorous prep work, and a really high tolerance for risk. Our deep dive into this Tony Hicks article really highlights that leverage itself isn't inherently good or bad, maybe. It's how it's used that defines the risk. And that parting thought from him really sticks buying the dip with leverage, not because I'm reckless, but because I'm prepared, having the plan, the strategy, the exit.
Absolutely. That metaphor he uses, surfing it on a jet ski, powered by leverage, it really captures that high-octane, aggressive feel, doesn't it? It's bold, no doubt, but supposedly built on this foundation of conviction and really strict risk management.
Which brings us to a final thought, maybe something for you, the listener, to chew on.
Yeah, think about this. Even if you would never, ever dream of using leverage this way, and most people probably shouldn't, what parts of that intense preparation he talks about, the deep research, defining your risk up front, the close monitoring, having conviction, which of those principles could actually make your own investment approach stronger, even if it's much more conservative? How could that level of preparation benefit anyone?